So hi, everyone. My name is Angie. I'm here with New Ventures BC, and we are having our weekly seminar series. So many of you have been here every week, so welcome back. And if it's your first time, thank you for joining us. So today's topic is on capital planning and programming update. I think I mentioned last week this session will be delivered by Keith Ippel from Spring. Keith had a last minute meeting he was pulled into in San Francisco. So he has invited Davina here from Spring also, who has also delivered this talk several times. So we are in great hands and looking forward to seeing Davina's spin on this. And before Davina comes up, we have Nikki, I know you, Nikki, from Futurepreneur here. And Futurepreneur is just a great program for a government program supporting startups. And I like to just, share the information. So she's just going to give you a quick 2-minute overview of Futurepreneur and see if there's any programs that might apply to you. So first, I'll just go through kind of my usual housekeeping stuff. So we're nearing the end of our long seminar series, which has been great. All the sessions are online though, so feel free to go back and rewatch or check some of them out. This is a week where we have 2 seminars. So we have capital planning today, and then tomorrow we have just a topic on SR&ED grants with our supporters, Ernst & Young. So that'll be a shorter one, maybe 45 minutes, the hour at the most. And that's just if you think you're SR&ED eligible or have questions about the SR&ED program. We've got 3 SR&ED experts coming in tomorrow to give you an overview, answer your questions. So if that's of interest, join us again, same time, same place tomorrow. Otherwise, next week, we'll move on to a different topic. The capital planning topic today is kind of a great overview, but we will have a few more topics, financing related, coming up. One of them being, we just added one more seminar because we just weren't enough. So June 15th, we have TELUS Ventures going over investor profiles. So we've added that just to kind of cap it all off. So again, New Ventures BC, nonprofit here to help BC tech startups. I will make one last note that we are in the last week of taking applications for our sales accelerator. So that's for in-revenue companies. Check it out, newventuresbc.com. Community events coming up. So here are a few. If you have a community event you want to promote, feel free to put it in the chat. And I'm sure Spring will have some events they want to share as well. So you'll hear more. But here are a few that are just coming up, and Liz will put the links in the chat for you. Like I said, videos and slides are available on YouTube and off of our website. You'll see a little seminars button on our homepage, and you can check that out. Otherwise, I'm going to thank my sponsors and pass it over to Nikki. So lead partner, title sponsor, Innovate BC. Gold sponsors, EY, Fasken, SFU Beauty School of Business, and the UBC Sutter School of Business. Our silver sponsors, Ace Tech, TELUS Ventures, Output, Vantech, and Volition. And lots of great bronze sponsors here who are supporting. And we're actually just adding one more called Backstretch Recruitment. And they're going to be creating some custom recruitment and HR topics around how to get talent. So we'll be delivering those later in the year with them. And our great media sponsors. So thank you to all our supporters. This is how you get a hold of us. And that's my little bit. I'm going to unshare here so Futurepreneur can get on board here. And always a pleasure. I haven't seen Nikki in about 2 years, but every year we have Futurepreneur come on with this seminar just to give you an overview of the program. So over to you, Nikki.
Thanks so much, Angie. It's so great to be here. Can I just confirm everyone can see my screen share okay?
Yeah.
Yeah, perfect. Okay, awesome. Well, thanks so much again for having me join. It's been ages, Angie, since we've caught up. So it's nice to kind of do this virtually. My name is Nikki. I work for an organization called Futurepreneur. And Futurepreneur is all about supporting young entrepreneurs to start their businesses. So the way that we do that, and let me just see if I can click through my presentation, here we go, is that we have a mandate to support young entrepreneurs between the ages of 18 to 39. And the way that we support them primarily is by providing financing and mentoring programs that really help you in your very early stages of your business, get your business off the ground. So the financing that we provide through our programs is a business loan. It's structured as a business loan. So we're not investors. We don't provide grant funding. It's purely structured as a business loan. And as I'm sure Davina is going to take you through today, there's so many different ways of structuring financing and getting capital and funding for your business as you are kind of in those early stages of figuring out what type of funding would really work for your business. This is just one way, right? Business loans and debt funding at Futurepreneur is one way that you can access funding for your business. But it's really designed specifically for young entrepreneurs to cover any startup costs that you have in getting your business off the ground. So startup costs, depending on the type of business, really vary. If you're opening a cafe or a restaurant, you'll probably need coffee machines and outfitting the retail space that you have secured and the location. If you're starting an e-commerce or a tech business, you'll have development costs, you'll have actual product if you're selling a physical product online on an e-commerce store. So there's a very wide range of different, what we would consider startup costs, but that's what the funding at Futurepreneur is really designed to be used for, is to cover that initial investment and those initial startup costs so that you don't have to invest in them yourselves personally. And again, we support entrepreneurs between this age range. But the funding is not the only thing that our programs provide. We also match entrepreneurs with mentors, business mentors, that really help support the entrepreneur and the business over the next 2 years of operations. So when you go through and apply to one of our programs at Futurepreneur, you're applying for 2 things at the same time. You're applying for the financing, the business loan, and then you're also applying for the mentorship component as well. And so when you go through the application process, we are kind of assessing your application on both of those pieces at the same time. And if you are eligible and if you get approved, then you get the funding in your bank account alongside this being matched with a mentor who is really going to work with you for that next 2 years as your business grows and scales and as you kind of expand out, and they will help with any challenges that come up along the way. So that's really what Futurepreneur does. Again, our core programs are financing and mentoring. We have a couple of different programs and they're structured slightly differently, and I'll take you through them really quickly on high level, but just so you know that these are resources there to support you. And then we also have some additional resources as well, which don't sit that you don't have to access our programs to access. So we have things like templates, which are available on our website. We have free workshops that you're more than welcome to attend. And we've got some other pieces as well. So I'll just take you kind of quickly jump through the rest of this presentation. I think Angie will share it though in PDF format. So if you wanted to go back and have a look at the details, because I'm not going to go into details, I'll just quickly go through an overview. So we have our startup programs, which are our most popular programs at Futurepreneur. They've been around for over 25 years. We have a few niche startup programs now. So we have a regular startup program, it's kind of our umbrella program. And then we have a startup program specifically for Indigenous entrepreneurs. And we have a startup program specifically for Black entrepreneurs as well. So our kind of umbrella startup program is a maximum, you can apply for loan financing of up to a maximum of $60,000. And then it comes with that 2 years worth of mentorship program as well. So the $60,000 is the business loan that you can apply for alongside that mentorship component as well. For Indigenous entrepreneurs, we have a whole team at Futurepreneur who also identify as Indigenous with lived experience to help you go through the application process and also connect you with a whole ton of other resources that are available for Indigenous entrepreneurs out there as well. So we really partner with a lot of key Indigenous organizations as well to help support you. And then we have our Black Entrepreneur Program as well, which is our most recent program that we launched, I think last year now, or the year before. Time is a bit of a warp for me, but we have our Black Entrepreneur Program as well. Our side hustle program is a little bit different. It's designed for entrepreneurs that are starting a business on the side and want to keep it on the side. But we have a lot of entrepreneurs who have gone through our side hustle program as well. It's a little bit different to our startup program in the sense that you don't have to have a completed business plan or cash flow. Sorry, you do have to have cash flow projections, but you don't have to have a completed business plan to apply for the side hustle program. You do have to have a completed business plan to apply for the startup programs, but I can take you through all of the pieces that are required if you're interested in applying. But just in terms of program supports, I kind of briefly ran through a whole bunch of other stuff that we have. We have, you know, the templates available online, but this is one that I wanted to encourage everyone to check out. It's called Rock My Business Series, and it's a series of free workshops around business planning. So if you're curious, I'll pop a link in the chat, and you're more than welcome to come check them out. They're completely free and available to anyone to join. But I'll leave it at that. These are my contact details. I'll also pop them in the chat as well. And Angie, you're welcome to share this deck too, but just wanted to let everyone know on the call that these resources are out there for you. If you're curious and want to learn more about Futurepreneur Programs and the financing and the mentoring that we offer, I'm happy to chat. So thanks so much for having me today, and have a lovely session.
All right. Thank you so much for your time, Nikki, and for telling us about Futurepreneur. All right. So now we are going to, and yeah, I think Nikki's contact info is down in the chat if you want to follow up. Okay. So now pleased to introduce Davina MacPhail from Spring, and Davina will be taking us through the main event, capital planning and everything financing, which I know is always a important part of the startup journey. So Davina, I will let you share your screen when you're ready.
Great. Thank you so much, Angie. And Nicola, it was super interesting to hear more about Futurepreneur. And so welcome everyone. Great to see all of you and hear and to participate in this session. I'm going to talk today about funding essentials. So we're going over all you need to know when you're kind of thinking of structuring your round, raising, what you will need to think about. And so a very open session here for you all to ask questions, think through your issues, and think through your questions around fundraising. So really happy to see you all, to go over this material. And also, I mean, so this session been pretty open, so feel free to use the chat to ask questions. If you want to come off mute, ask questions, please feel free to do so. I'll have dedicated times for questions, but we'll try to keep this as interactive as possible. And AG would be my here with me to help me keep this keep your questions coming. So feel free to do that. Great. And so wanted to thank New Ventures BC and Angie. Thank you so much for inviting us to be part of this journey. We've been great. So you've been great supporters of the tech startup ecosystem, and it's we've seen amazing companies coming out of this challenge. So really excited to be here and meet all of you. A little bit about Spring. So at Spring, we're here to change the world through innovation. We do that by being a B Corp certified and 1% for the planet. That means that our values are aligned with also our missions and our internal processes and the way we work, and there to really push and support companies who are here to change the world to have the right tools to do so. And so just a little bit, a quick overview of how we work. We work on one side with the entrepreneurs, who are in growth phase and trying to find the right tools to finance or to fuel their growth. So we've been lucky enough to work with a lot of entrepreneurs over the years, and we also work with investors. So on the other side, also two sides of the coin, of course, very important also to support investors in their journeys towards investing in startups. So we also have programs to support investors, and in the middle, we of course we get to meet a lot of organizations that are supporting entrepreneurs and investors, and we're also consulting and supporting these ecosystems that you see in the middle to support all these ecosystems. And so we've been very lucky to work all over the world doing this work. We're of course based in Canada, and most of our work is based here. We're based in Vancouver, and we've been active also in Europe and Southeast Asia, and more recently also in the Middle East. So these are a bit of our stats, and so the number of people that we've supported through all of these programs. Interesting for you to see here is the amount of funding we have raised. We have supported companies in raising. So this 25 million is represents all the support that we've been given to entrepreneurs to raise, either through our funding roundtable programming, but also with our impact investor challenges that I'll touch a bit upon at the end. Great. So the agenda for today, so we're going through all these different stages. First, how do I, when we talk about raising funds, structuring around, these are the big questions of how do I tackle this issue and where do I start? So this will be kind of working on that first. And then it's talking about goal setting, capital raising, just giving you an overview, the different types of funding, wrap up, and next steps. And also just to give you a little bit of background by myself. So I'm program manager in the investment team here at Spring. Before that, I worked in an impact investing fund. So working on the VC side in Europe mostly. So I've kind of seen a lot of companies going through early stage rounds and structured deals and early stage investments. And then before that, I was also working in a venture in Cambodia, where I help raise several rounds for this company. And so I have both kind of seen it from the entrepreneur side, but also from the investor side. So happy to answer also any questions and share those experiences with you today. So the first steps to starting around, what we like to the way that we like to talk about this and how to get started really when you're thinking about raising capital is to really see this as a 10-step process. And kind of I wanted to take you through these 10 steps to so that you can also already start structuring kind of how you're going to go about raising funds in your head. See where you are, what you've done already. So some of you might have already raised friends and family, and some are kind of maybe just thinking about it in the process. So we're kind of I'm going to take you through these 10 steps to really get a bit of structure and ideas how to do it. And so the first step is really to set goals. And that's really important. Most ventures who are thinking about raising funds, we say about 90% of the startups, they don't really set a goal at the start, meaning, what is the amount that you want to raise, by when, what is your timeline, and, who are your ideal investors. And so these are important goals to set at the start. Of course, they will change, but having them written there for you to look at and to, kind of then define your process based on these goals is really important. And really important, we want to stress that because it makes, it will make, all of the next steps and all of your discussions and all the way that you will then structure your raise a bit more clear if you have these goals right from the start. Second, important also is to define your ideal investor. I mean, same way when you're, structuring your business, thinking about your clients, you kind of have an idea of who your clients might be and how you want to target them. And for investors, it's the same thing. You really have to, kind of think of, what kind of investors you want, for what type of funding, and also like what kind of industry and kind of how you want them to be aligned or with the activity that you have. And so identifying targets, there's a lot of lists. I'll go through that again, and I understand there's going to be a session with Tellus also on identify investors, but this is also really important. It's not like when it comes to investors, not whoever can give you money. It's kind of also on your side defining what you want. So that's also important. The third step would be to select a lawyer with experience in the area of fundraising. And so that's also super important because while you're thinking about raising funds, once you get closer to closing with your investors, lawyers will be involved because there's legal paperwork involved. And so also kind of having an idea of who are going to be the people supporting you from a legal side in that journey, is important to set up at the start. And lawyers, they also have their sales process, so kind of it's kind of going and meeting lawyers here. Like you can also consult with people in your network, companies who have raised that ask them who have they been working with in terms of who has done their legal support, were they happy with whoever they worked with. Ask around to find the right people and ask for recommendations, and then go and meet these lawyers it doesn't mean meeting a lawyer doesn't mean you're hiring him, right? Or her. It means that you're kind of first getting to know them, see if there's a good fit with you, if you get along well, if they get what you're doing. They have also the right expertise to support you in doing that. And that's a great way to, start also your thought process, getting, of course, as I was saying, there was a sales process for them. So they would probably also give you advice on how they think you should go about it. This is also useful. It's kind of free. Of course, this is, along the line, it won't be so cheap, but, take advantage of these early discussions with a few lawyers that were recommended to really help you structure also your thinking. And, these lawyers, they will help you both make sure that you have the right paperwork in your company to welcome investors, and then they will help you drafting the documents, so we'll talk about that a bit later, but if you're doing a convertible notes, equity, shares, so these lawyers will be there to structure the deals with you and to make sure the language is what you want it to be. So there's these two sides of what lawyers will do with you, and then it's true. This is investment is kind of pretty also there's a lot of legal work that's involved. So the more you also understand all of this, the better. Any questions on this to start? Checking the chat.
I think we're good for now.
And so then, after you've done this, fourth step would be to start building your financial forecast. This is, of course, will be very obvious for some of you who have already kind of financial minds in the teams, and maybe a bit less for others who are kind of more focused on product rather than the forecast. The kind of building a 3 to 5 year forecast, depending on also how far along you are. If you're really at the start, 3 years is good. If you already started operating, 5 years is kind of a better target to have. These forecasts, they're not supposed to be, of course, these are assumptions, right, that you're going to make on where your business is going to go. They're not, of course, they're not set in stone. You have to keep an open mind on them and stay, not put too many expectations in terms of how precise they have to be. But they're really important because when you have your first discussions with your investors, it will be very useful for them to see how strong of a grasp you have on how your business works. And so having forecasts, of course, is useful in itself, but it's also useful in what it tells your investors, in terms of potential investor, in terms of how much you know about your business, how will you kind of also adjust, certain aspects, if the growth, sales growth is not as strong as it was supposed to be, what will you adjust? And so that's why we're talking about having 3 scenarios. Having a forecast is great. Having a forecast with several scenarios is even better, because it shows that also you yeah, you know what you will do, and you know how you will adjust your, your hiring or your plans based on the growth that you will have. And so actually Futurepreneur has great resources online. Also, if you want to see templates of financial forecast, and you can be over 39 to access those, so it's pretty good. And so, yeah, like have a look at a few templates. There's a lot online. Futurepreneur has some, but also you can find others. And so this is usually it, and it takes time to build financial forecasts. So make sure that you really yeah, like plan for that in advance and start early on looking at these forecasts. Then a fifth step that's also useful is to start working on a due diligence folder. So due diligence, for those who don't know, this is how investors call homework. So due diligence, when you hear DD, due diligence, it's just the same word as homework, and it's the homework that investors do when they're looking at a company. And so quite useful to have is to create a drive that is accessible, that you can make accessible to people who are looking at your business, and start inputting, information on your company. So your decks, your deck, your forecast, of course, your past financials, if you have some, also any analysis that you've done on your company, on competition. And so these drives, it's good to also start early on, just setting up a structure. Happy to also share. We have at Spring resources in terms of what should a typical data room look like. So I'm happy to share that after the call and give you also access to that. And so a good place also to start. And then sixth step would be to ask lawyers to create draft financing documents. So these are also like a basic term sheet. When you've kind of figured out how much you want to raise and what kind of financing you're looking at, ask a lawyer early on if you have a pretty good idea of what you want, to start drafting some documents. And then, so we move on to the next slide, and let's talk about the seventh step, which is to build your pitch deck. And so this might be a bit surprising for some of you to say, oh, so well, wouldn't that be where we start to first having the pitch deck? We at Spring, we recommend really seeing that a bit as something that you do once you kind of have been through these first steps before, kind of setting up your goals, identifying maybe investors that you have in mind, and then kind of having your house in order. And then this is when building your pitch deck will be also the most efficient for you, and you will be the most efficient in building that pitch deck. And so of course that kind of thinking about your pitch, thinking of the slides to support that. It will be of course, it is an essential step. If you don't have a pitch deck, this is kind of very important for you when you raise. And what we recommend is really to get it reviewed. So both getting the slides reviewed, send them to friends, people in your network who are sensitive to what you're doing, have a bit of experience in that, and share externally this deck. And then of course, like practice your pitch. What we say here is like, try to at least pitch 12 times before you're kind of really go out there and start pitching to investors. Start practicing with your friends and family, people around you. The more you practice, the more fluid you will be, and the more comfortable you will be delivering your pitch. And this is really important when you we don't really know sometimes, like a pitch competition, well, that's very precise, exactly when you're going to pitch, you practice for that. But when you're talking with investors, you don't really know how much they will expect you to really have a clear pitch, or just a free floating discussion. But so be as ready as you can. And of course, your pitch deck will evolve in time. Every time you have something new in your business, you will need to adapt your pitch. But and then repracticing and making sure you're very clear on what you want to say about your company will be very important. Yeah, and then once you've done all that, start reaching out and getting intros and starting. So we'll move on to the other slide. But and then once you've done all these steps, then you should be ready to start reaching out. So happy to take a quick break now, or not a break, but if any questions. Happy to answer.
If you want to ask a question, you can raise your hand or pop it in the chat.
So I'll keep going, but feel free. Oh, Eve, go ahead.
Yeah, hi, Davina. My question that I have for you is, so we are a hardware company, and one of the challenges that we find is in our region of Victoria, BC, there's a lot of investors who really understand the metrics behind software and SaaS businesses, but we find it's challenging to find people who really understand hardware because it is so different. The metrics are so different. The pace is so different. So I wonder if you have any advice in terms of how you can sort of find investors who have the right industry knowledge for your type of business.
Yeah, I mean, I think that's a great question, and it's of course super important. You need to people, to speak to people who get what you do. When you're talking about, I mean, so you want Victoria specific investors, or would you consider widening a bit the scope, the geographical scope?
Yeah, definitely could widen the geographical scope. We just have the most connections here.
Yeah. No, it's true, and it's so I think of course it's really important to have investors who are aligned, and investors will invest in things that they understand, and so as you're saying, people who are kind of maybe in a different mindset and used to invest in different companies might be a bit trickier. But it doesn't, you can ask also these people if they are interested in your business, you have good connections, ask for intros. And they might know people who are more active on the hardware side, and could recommend people for you to contact. But for sure, if you see that these are very specialized investors who are only invest in this type of business, well, it's not worth you wasting too much time and their time either, and focus maybe. So we'll look at networks and angel networks that might be more appropriate. But and if you have in there investors that you get along well, who are kind of keen to support you, I mean, there's no harm in asking them just for general advice on your pitch, for example. And so, if they are investors and used to seeing startups, they might be also happy to just help out, kind of using this kind of personal connections and local connections. And you can use them, although they might not be investors, they could also have good advice. So that's valuable. Yeah.
Great, thank you.
And we have one more. Tim has his hand up there.
Go ahead.
Go ahead.
Oh, hey, yes. So I think this is a theoretical question, but people say you have to ask a lot of people before you can get funding. But at what point should you start thinking, this just isn't working. It's me, it's not them. Do you see what I mean? Like, you're asking the wrong people, or your pitch is wrong, or maybe you're just never going to get funded because people just don't believe in what you're doing. So where's the signal there? Like, after you've pitched to 200 people, should you be like, okay, maybe this isn't for us?
Yeah, I mean, it's the question of the timing, I think, also is important here. It's also, well, of course, if you're, I don't know what your business is, but of course, if the idea, if you have a lot of this feedback, maybe then, maybe it's time to pivot, or I don't want to I don't know what you do, but of course, investor feedback, I mean, it's kind of giving you a sense of the market. And of course, like two or three opinions you know, might be wrong, but you know, the more you get, the more you kind of give you an indication of the appetite in the market for your product. So but sometimes also it's just not, you know, your idea is good, timing is not great, and so yeah, it's about figuring out also if you know, raising fund is the right thing now, if you can, you know, continue like financing in other ways, bootstrapping, and then coming back to investor when it's the right time and they're ready for you know, for you.
Okay, cool, thank you.
Davina, there is one more. Do you want to take one more, or do you want to?
Steve, is it a quick question? Yeah.
Very quick question.
Yeah.
So to ladder on to the earlier comment that you've had, I'm in a medical device business in Victoria, and it's even harder to find people to understand they understand very well, I guess, the risks of medical devices and how long the curve is to get it to market. So impact investors seem even more important to me, but I don't think I've actually had a conversation yet with an impact investor. So I guess maybe leave that as a comment.
Okay. No, great. I mean, yeah, so for sure, medical equipment is challenging because of this. Yeah, I mean, getting the product to market and validation. So, but there are people who are specialized in this area. So happy to discuss this further or in private. Also, yeah, feel free to connect on LinkedIn. Davina, MacPhail. Happy to also to support you if to answer any questions. Okay, so moving on, we're talking about, so one of the first steps that I talked about was goal setting. So what is, you know, giving you a little bit more information on that. You know, it's, of course, raising capital is, I mean, for those of you who've heard about it, it does take a lot of time. It's true. I mean, so it's something that you need to be prepared for. I think, you know, was it Tom or Tim who mentioned that, you know, pitching to a lot of investors, yeah, of course that takes a lot of time. You know, what we're saying is that, you know, it's you know, first, you know, if you have your goals clearly set out, if you can find a way to be efficient, you know, it doesn't have to take all of your time, but also it takes, it can be a full-time job, but not all the time. So usually raising capital is the most time consuming is really at the start, when you're starting to build, you know, your material for this, starting to reach out, speaking to investors. This is kind of when, you know, most of your time will be busy with that. But then, you know, kind of there's a bit of a curve. So, you know, once you kind of get some discussions going with investors that you've identified and who are interested in your business, then you kind of, well, you know, don't have to spend all your time on it. You know, it's kind of following up on discussions, you know, answering questions, meeting up regularly, but you know, you can still run your business as you're doing that. But then it kind of ramps up again, you know, at the moment when you're closing. So closing in kind of investor jargon is kind of when you know, you get the money, basically. And so just before finalizing, you know, around, you know, also this is when you'll be super busy with just that and legal negotiation, you know, working on the negotiating the paperwork, finalizing the terms, you know, having back and forth discussion with investors. This is also so kind of, we like to see this as a curve. And yeah, and then, you know, if you're kind of clear about your goals, of course, you know, that all the less time spent kind of going back and forth between, you know, different goals. And so important to know, yeah, I mean, just kind of important to have this timeline in mind and to manage this process efficiently, as you would in a way any sales process. So in terms of key goals to identify, you know, who is your ideal investor? You know, it's quite important to kind of identify, you know, what business, and as a question that was asked before, I mean, of course, yeah, if you're in hardware, software companies or the software investors, people who are just used to looking at that won't be a good fit. So, just finding people who are in the, and that's not easy. I mean, I'm not saying it's easy, like finding these people, this is kind of one of the main challenges. But kind of defining those in your head, having discussion with investors and fine tuning also as you go along, as you speak with, investors, will be important. And of course, the impact elements, and how what will they value in your business? What do they see really aligning with, what they as investors trying to do, will be important. And this is what you get also with discussions with these people, and getting to know a bit your company, how you're looking for investors, and also what investors are looking for. And then how much do you want to raise? So, it's easy to say, kind of define how much you want to raise, but it's great. It's also good to have kind of like a bracket. So you will have a target amount that you need to raise. You've kind of identified, making your projections, seeing what kind of investment you need in your business to take it to the next level. Gives you a target of how much you want to raise. But then it's important when you have discussion with investors, to say that you're raising up to a certain amount. You don't want to, of course, then life happens. You'll see, the appetite for investors for your company. Maybe it will be very high. Maybe it will be more limited, or people will see maybe a lot of risks, so will be keen to invest, but maybe not as much as you would want. And so it's good that you have a clear message in terms of what is your target, communicating about that target to the investors, because they will want to know, okay, so how much do you want to raise? And that's kind of a very important question, and something where you can't be too unclear about how much you're raising. You can't just say, as much as I can. You have to have this clear amount. But you have also to kind of have an answer prepared. If you for example, you want to raise $500,000, but then you find three investors for $300,000. Then what will you do? Will you say, then will you cancel your round because it's not the exact amount that you were planning to have? Either the answer is yes, or the answer is no. I of course I will take this investment and I will do what I can with it to really grow my company. And then also on the other way, sometimes some investors really get really excited about a business. They have a minimum amount that they would invest, so they will offer more than actually what was your initial target. And you have to be prepared also there. Okay, if you're oversubscribed, as we call, if you raise more than what you were planning, and if you get more interest than what you were initially planning, then you have to have also a plan for that. And if suddenly there's more money coming in, what will you do with it? And you have to be ready also to talk about it and explain and give a justification. If you say 500K and suddenly you're at 800, your investor will want to make sure that then you have a clear plan on what you will do with that funding. And then what kind of money? So of course, there are very different types of funding available, being grants, loans, crowdfunding, friends and family, angel investors. All of these financing tools are there in the market, and it has to be. You have to also have an idea, of how you want to raise, what kind of money you want to raise, and from whom. So it's important to have this idea, and if it's a mix of several of those, great, but have kind of dig a bit into what different tools are available, understand them clearly. Being part of this challenge, with New Ventures BC is also part of that, and kind of figuring out also all the tools that are out there. So important to kind of get a clear idea about that. And then you know, your timing, when you want the money in the bank. So and when we're talking about angel investing, what's important to know, and so when we talk about angel investors, private investors, people who will invest directly in your company, you know, there's a bit of a seasonality there, because, you know, people like, so usually the summertime, I mean, and that's true for either angel investors, but also from VCs and more institutional investors. Usually summertime is just when people take their holidays, and that's a fact. You know, there's not that much you can do about it. And so timing your round so that it doesn't fall within these big holiday periods is quite important. And actually, you know, we still hear, like, you know, here at Spring, you know, companies saying, okay, I'm planning to close my round on, you know, 31st of July. And, you know, this is usually, I mean, this is not realistic. Either people close before the 30th of June, or they close, you know, on the 15th of October. Summertime is just not the right timing, and same for Christmas time. So, you know, having like a bit of a plan in terms of how you need, when you need your funds in advance is quite important. And of course, kind of anticipating as much as possible so that you not, and you know, arrive in a situation where you really are desperate for cash. That, you know, and then you kind of, yeah, I mean, all the power is of course, you know, like the bargaining power is diminished for you. So anticipate and try to avoid the big holiday times for your closing. I thought it was a hand up if.
There is a question in the chat from
Yeah.
Steve. How do you plan for closing a round? It is difficult at the moment to predict the future.
Yeah, I mean, so I guess, you know, it's you know, of course, with COVID, everything's been, you know, been kind of more difficult and more challenging in terms of timing. But I think, you know, we did also see that life goes on, and that investors are still in the market, and they're still keen to do investments. So you know, it's having early discussion with investors, understanding also their timeline, you know, planning accordingly. I mean, I have a bit of yeah, sorry, I'll be talking about the timing of different investments, but, you know, kind of making sure that that you plan for enough time for you, you know, at least 6 months before closing, starting the investment process. You know, that's really a minimum. And yeah, and having warmer discussion with investors, getting an idea of the timeline. Yeah, I mean, that's the most important. I don't know if I'm answering the question. If you want to come off mute.
There is also another.
But yes. Oh, I'm sorry. Just to follow up on that.
Yeah.
So can you close a round with partial funding and spend the money that's been committed, or you have to make that round or not spend the money? How does that work?
But so there's different ways of doing that. I mean, so you can have bridge rounds. So that means that the bridge is kind of, you know, while you're closing a round, you can have investors who come just for this interim period, or some financing that comes for interim periods while you're closing a round. But you know, usually when you're raising a round, you know, you would wait that your round is closed to start spending the money. Yeah. But yeah.
And then in the chat, Farzad asked if you could please repeat the dates that are not realistic from fundraising timeline perspective.
Yeah, so we say, you know, July, August, it's very difficult to close. So I would avoid July and July, August, and then, you know, the end of December. So if you're like you can plug, you know, so, you know, January to 30th of June, And then, mid-September, let people come back from their holidays and Labor Day. And then, 15th of September to 15th of December, to be precise.
And then there's one more, if you have a second. It's Ellie wants to know, could you please elaborate more on angel investors and how to close the round with them?
Yeah, so angel investors, same as a more of a traditional investor, institutional investor. I mean, these are individuals. Usually, angel investors are wealthier people, so people who would who are accredited. In Canada, you have to be an accredited investor to invest in a private company. And so there's a kind of a definition for that, and you have to have a minimum amount of wealth and income to fit that bill. And so these angel investors, yeah, I mean, they operate as any investor would. It's because they have a direct relationship with you in discussing your round. So you would want to have early discussions with them. Then they will do their due diligence. They will study your company, make sure they're comfortable with all the metrics. And then once they feel comfortable, they will invest in your company directly. So that's when you have to have lawyers involved. And so to draft the paperwork for them to do the investment. And yeah, so they can be part of a bigger round. If you have several, if you're in, if you have like 100 or a 200K round, you could have, 3 or 4 angel investors. You could have just one, but you could have several also. And so kind of making them work together, not work together, but like working with them so that you close the round with the same terms at the same time, will be the most time efficient for everyone. And then, yeah, I mean, yeah, then they sign the paperwork and then it's money in the bank. I don't know if it's answering the question.
Sounds great. Thank you.
Okay. Great. So I'll move on. So I just wanted to share about kind of, I talked about it already, like the different types of funding. Of course, you are the primary source of funding for your business, and usually most of you have probably invested in it, and this is kind of the easy to go to. Of course, depending on your level of wealth, it will depend. But then also if you can generate income early, your income and the income generated by your business will be the first source of funding and the preferred one. Then you have your friends and family. So with what we call also in the investing business, this is called love money. So you would also have heard about that. And these are the first people who actually support you in your business. Important to make sure that their investment is clearly identified, documented. So there's no issue going forward. So sometimes people will also go through lawyers to structure and just to formalize the investment that was made. Revenue, so this is also what I was meaning just before. Grants, of course, there's a lot of grants available for startups in Canada, either to support your investment, but also all types of hiring grants, innovation grants, and so I think there is a session on that. NG, correct me if I'm wrong, in the challenge, but you will learn a bit more about all these grants that are available in the market, and then loans, equity, and equity crowdfunding. And so it's important also here, that you understand all these different these different pieces that are here. Often equity is seen as something that's a bit murky and not so clear, or something that people like startups get a bit worried about and kind of uncomfortable around. And so understanding as much as possible, what exactly does it mean when you open your capital to external investors is important in order to make sure that you're not working on, kind of going based on assumptions. Same for loans, some people will say, no, I don't want to take loans. This is, I don't want to take that risk. But kind of understanding also how they work will be very important for you to once you're doing this and embarking on this funding journey. Understanding the products, asking about them, meeting with your bankers and discussing the different elements and the different options that are available. This is really important. And equity, of course, I mean, this is why we're here today, to kind of demystify a little bit about what it means to raise equity. And so I wanted to kind of share this, like the timeline. So of course, all these different financing tools that I described just before here, they all have also very different timelines in terms of how long it takes to get. And so this is important because it will help you build also your plan. And equity, does take time to raise. We did mention that it will take some of your time, but it also takes a certain period of time to plan for. And as we were discussing also before, the issue here, and why is it shorter for grants and loans? Sometimes grants also do take a lot of time to get, but loans usually are quicker. The important thing to know here is that when you have a loan, you have a very clear contract with repayment terms. So the lender has a clear idea of what their own liquidity will be. Liquidity meaning when they will get their money back. And so in a loan contract, it's quite clear, you set the term, like you and your lender usually sets the terms of repayment, you have to respect those. And these are, so pretty clear cut. The thing with equity is that usually the liquidity for the investors is not very clear. They've accepted, they've invested in your business, they've taken a share of capital, they put some money for you to grow your business. But then there's the big uncertainty for them as to when they will be able to exit and to get their funding back. And so the way I like to see this is that, it does influence the time that it takes for people to make a decision for investment. So, kind of have in mind that, if an investor takes time to make his decision, this is also what they're thinking about. And, this is so be mindful of that, they have to think about their own liquidity, and this influences the time that they will take to decide. What's interesting on the crowdfunding part, crowdfunding and equity crowdfunding, usually is that these crowdfunding campaigns. If we have time, I'll talk a little bit more at the end about that. What's interesting with that is that usually there's a precise timeline when you do a campaign and to raise equity on the crowdfunding platform. They will tell you, okay, you need this will be a 3 months campaign. And so this gives you a little bit more assurance in terms of how long this is going to take. But yeah, I mean, like the equity does take a bit of more time than of course, friends and family and revenue. So common paperwork. This kind of I don't have time here to kind of go through all these different instruments. I just want to kind of give you, an overview of all these, all the different ways that an equity round can be structured in terms of, the kind of the tool, the investment tool that is used. So common share, that's the most basic way for you to raise funds. However, it means that you have also a clear idea of the valuation of your company. So how much your company is worth. So common shares is usually what investors, what is easiest for investors to invest in if you have a valuation, and if they're, if they are aligned with the valuation that you're asking for, and they think the price is reasonable. Common shares is also for investors. It's the most where it's the most well, say equal, but I mean it's common shares means that investors are on the same footing as you are in terms of ownership of the company. So if of course the percentage they will have usually will be much smaller than you have, but you will be a shareholder of the companies with more or less exactly the same terms. So it's the most equitable role. Yeah. And then if valuation is difficult to set up, or if you're too soon, too early to actually have a valuation of your company, but you still want to raise funds, there are other ways. And so these are the two products that are listed below. One is the SAFE. So SAFE is a way for investors to invest in your company with the possibility then to it's a future access to equity. So they put the money now, and then they negotiate the terms as to how will they convert that investment into equity at a later stage. And so that is a tool that is used quite a lot by early stage startups. If you look at the Y Combinator, they have a lot of resources there to, I can share that also with you after. And there's a few YouTube videos that explain very clearly what a SAFE is. And so this is for you on your cap table, you will consider that as equity, as a SAFE that is a piece of equity, but the shares are not yet converted on your cap table. And then you have the opposite tool, which is also a convertible instrument, which is a convertible loan agreement. So that means that investors, instead of getting future access to your equity, they give you a loan right now that will convert into equity at a later stage. And so that will be, if you look then at your balance sheet, a SAFE will be on the equity side of your balance sheet. A convertible loan will be on the debt side. So this is additional debt that you will have to pay interest on. But it also gives you the flexibility not to set your valuation right now and to do it later. So it allows you to raise funds without the valuation. But and then these investors will get a chance to convert their loan agreement into equity with likely like preferential terms, because they kind of took a risk and financed your company earlier, so they kind of need to be also rewarded for that. So this is what we talk about, the discount on the valuation. And then you have preferred equity. So these usually they come later on, once you're doing a Series A, Series B. So this is when you're raising like bigger rounds, and investors will try and also get preferential terms. So this is the opposite as common shares. Common shares, everybody's on the same footing. Preferred equity means that there are some certain terms that are preferable to investors. For example, they will get priority if there's an exit. So there's a whole bunch of. They will also maybe have some certain rights on decision making in your company, but this is kind of something to think about later on. Any questions here?
There are a few questions. Let me just see what we got here. Some are related to the slide, some are, I think, are just more general. One's, can you talk a little bit more about ICO?
Oh, can you come off mute and explain?
That's Lynn.
ICO, Lynn?
Yeah, I just want to know, like, if that is even a reasonable option.
Sorry, I'm not sure what ICO is, if you could.
Oh, so it's initial coin offering. So basically, you are creating, say, like a ERC20 token, and you sell it to public online. They give you other cryptocurrencies instead, and then they receive some of the tokens that you created.
Okay, so I'm not really familiar with that, so I'm not sure I can answer that question. So
yeah, because I hear there's a lot of it used to be very popular, but for a while, and then there were a lot of scams in that area. I mean, in general, in blockchain cryptocurrency, there's always a lot of scams. So I don't know what the environment is. It's like right now, because the company that I'm founding actually is in the area of Web3 and has a very close tie to cryptocurrencies. So I'm just wondering whether, it's all like, it doesn't work anymore, or I'm just wondering what the funding environment's like for that option.
Yeah, I mean, I'm sorry, but this is not really my area of expertise on cryptocurrency. But you're right, in the sense that it's very important to also get a flavor in the market for what is currently being done in terms of products and financing products. So, I can't really help you on this specific product, but very, very good thought process now that you have of wondering if it's still a product that is done, and something that, all startups should also think about and think about the larger group here. Do ask around for people who are specialized on those topics and see what is done in the market, indeed.
Yeah, New Ventures BC, we run VEF's events, and we actually just had a blockchain event yesterday, and what didn't talk about ICO specifically, but lots of talk around the climate and the situation. So the recording for that should be up pretty soon, so we can always share that as well. Okay, moving on here. Some of these you can defer some of these questions to the lawyers if you want, Davina. Corporate structure is next week with Faskin, and they'll talk a lot about some of this stuff, but Arjun's asking, is it possible to have share classes that dilute differently?
Yeah, so I mean, of course, if you have a session on that, I will let them answer to that. But in terms of dilution, of course, if you're if you have, I've not really seen like dilution, like you do have several possibilities of having several classes of shares, of course, share class A, class B, depending on what you've set up. Usually you will have class A will be your standard shares. And then once you create several other types, you can create class B. And those can give you preferential rights. Or give different rights, or kind of lower access rights. Usually those come with like additional voting rights. So class A, for example, will have additional voting rights on some decisions, and then class B will have less. And so, but on dilution, it's a good question. I guess then that depends on what you structure with your investors and what they're willing to have. So these are usually contractual agreements. And I mean, that would be my basic answer. But of course, if you have lawyers, it's worth asking the question more precisely.
Yeah, we'll cover that more next week as well on corporate structure. Another question, I'm not sure if you've covered crowdfunding yet because I had to step out briefly, but Ali's asking what the advantages are of crowdfunding.
Yeah, so I will talk about it later on. I mean, crowdfunding, what is interesting, especially for B2C businesses, is that it gives you a lot of visibility. So a crowdfunding campaign is both, I mean, it's a kind of double, catching like two birds with one stone in terms of, raising funds, getting cash, but also an opportunity to share and to communicate about your business. So it's really interesting. It's mostly interesting for B2C companies. And so companies who are really like kind of, every customer counts and getting direct access and working on people's networks. I think that this is the main advantage of a crowdfunding campaign.
Okay, and one final question from Eve, which again, maybe lawyers will cover next week too, but what's the best for equity in an employee stock ownership plan?
Yeah, so in terms of ESOP, same thing, like seeing also what you want to do, how much of your capital are you interested in sharing with your employees. I think usually this gives you either you have like common shares or maybe class B, and so class B shares or shares with other voting rights, where I mean the advantage is of giving equity to your staff, is to motivate them for the growth of your company, so that they also get access to the wealth that is created, and not maybe to get them to vote on very important management decisions, although it could be also the case. So, but yeah, I would say like common shares. But same question. I mean, you might want to also discuss that with the lawyers. It might be also an interesting discussion.
Awesome. Okay, let's keep going.
Great. Okay, so I'll briefly touch on the ideal investor. You can, also have that in mind with your the session with Teles on that. But just to give you the spring perspective on this, there are a few universal truths. Of course, having investors who know your industry is super important. And these will be they will be the people who are actually interested in your company in the first place, but these are also people who will bring value to your company. Of course, people who also, in terms of business model, people, talking about B2B, B2C, whatever is the structure of your business, having people who have worked with similar setups would also be important. These are also people who come with networks. Okay, so they will bring cash, expertise, but also people and their own network. So this is also very important to think about and to ask about or to research about when you're speaking with an investor. Also geographic relevance. So of course, based on what you plan to do, if you're very local, if you're planning to expand in Canada, if you're expanding in North America, having people who are on your roadmap to growth, having investors who are kind of aligned geographically will be very useful. Penetrating a new market is difficult. If you have investors on your side who can do these introductions, who have the local knowledge, will be useful. But of course, having people close by is also very useful. Investors who you can just call up, go for a quick coffee, discuss, some certain issues, and help you kind of not feeling too isolated in your management decision. It's also very useful to have investors that are close by. And then also people who are aligned on, returns and exits. This is also very important. It's a tricky one because you never know. Sometimes investors are very keen on the business, and suddenly they invest, and then suddenly they realize that life happens. They need the money back. And that can be a complicated discussions to have. So making sure that you are at least at the start aligned on what they're expecting in terms of returns on your business, and that they communicate clearly with you on what's the exit strategy. Are they there for 2 years? Is it a 5-year investment? Are they really there for the long haul? It's totally okay to have this discussion right from the start to understand what their timeline and returns are. And then, of course, for those of you who are impact driven, it's important to showcase that and to make sure your investor aligned. And then, so these kind of more universal truths, and this applies to everyone, but then there's also, what matches with you. And, making sure that your investors align with your values, that's super important, of course. But then just making sure you get along with them, as someone that you will want to, that you will see and spend time with, and someone that you've kind of, trust with a piece of your business, and that, and so they're involved with you, and so they're here for the long run, and make sure that you are comfortable with them. Where to find them, and so nowadays, it's more easy to find angel investors than it used to be. These people are usually, they communicate about, investors will now share about the fact that they're angel investors. You can find them on AgentList, on LinkedIn, and on kind of all these different platform, Crunchbase, Gust, NACO. So use all these tools that are here. Of course, if you sign up for pitch competitions, this is where angel investors usually go to find companies. So do go to these competitions. You never know. It does take time, but these are also the best places to meet with investors. And yeah, I mean, the important here is that, just to a glimpse into how investors think, the main questions for them when they are deciding on investments is, first, will I get my money back? Then can I trust you and your team with my money? It's kind of building this trust relationship that is really important. And if they feel that they can trust you and that they will, they feel secure that they will get their money back at some point, preferably with a bit of a return, of course this is kind of what will trigger their decision making. And so all this due diligence phase that we talked about previously, and setting goals and being clear about your goals, this is really important because you're really building a trust relationship, and being transparent. You don't need to know all the answers, and if you don't, share about like the things that you don't know, but really prioritize the building of the relationship. This is the most important. So just I'm conscious of time, right? We have only 15 minutes to go, Angie, right?
Correct, yeah.
So I'll just want to share about this managing the funnel, and to give you also to answer the questions of, in terms of timeline, it's not easy also sometimes to just understand, and also the question on how do you close with angels. There are several steps before, from the first discussion that you have with an angel investor at a pitch event, a side discussion, to the moment that you get the money in the bank, there are quite a few different steps. And each steps is a way closer for you to get to, money in the bank, but it doesn't mean that it's a yes, And so here we're just kind of describing the different steps, first initial call, are they interested? If they're if you see interest in your company, that's 10% closer to money in the bank. Follow-up meetings, we say 25%, sorry. Then due diligence, and then there's a verbal commit. They're like, okay, I'm in. But that doesn't mean that it's a done deal. It means that they're interested, but they will still, want to do due diligence, make sure that, they cover all the ground. They will review the paper. They will be, they'll be reviewing paperwork. There's a lot of uncertainties there. They might say, okay, I'm in, I want to invest, but then you still have to negotiate all the paperwork. And that's also often these are very sensitive times where, an investor might say, okay, you know what, I'm not interested anymore, thank you. And so be careful that these are really sensitive times. And then, paperwork is signed, that's 90%, and then money in the bank. So normally that should be 100%, but you never know, it might still be some uncertainties. And so, they're really there when the money's, when you have the cash. So these are kind of the different stages of the funnel. And yeah, so kind of like how, now that you've done all of this work to prepare, how do you then get out there? I think we've kind of described all of this. I think here the main point is this first one: know the state of your business. When you go to speak to investors, make sure that you're very clear on your metrics. When they ask you very basic questions on your business, if you've raised before, you have to be precise on the amount. What are your current sales? Be also very specific. And so know your metrics. Make sure it's not, you're not always saying, oh, well, on financials, okay, well, talk to my CFO. No, like you as CEO, you have to know what you're talking about. The pitch deck, of course, has to be ready and tested. You prepared your due diligence. You have, your team is also clearly in place. Or, if you don't have a team yet, kind of have a clear vision of what kind of team you want once you raise. That will be also super important for investors, so that it's not like scrambling along and kind of making sure, like figuring out if they feel like you're not very clear exactly what you want in terms of a team. That especially for an early stage startup, that will be a very important part of the process. Yeah, and then meeting with investor. I think kind of also how do you meet? How do you get access to investors? This is kind of Keith Apel who does this presentation, kind of like a strong recommendation from him, and I think it's a really good one. is to, you know, use your network and see if in your network you have company, like people like managing companies, and you're interested in getting those same investors. Try to get those CEOs to make an introduction. I mean, this is super valuable. Like an investor who will receive a recommendation from one of the CEOs that they invested in, you know, it's a huge it's a huge support in terms of them to actually take the call and take the meeting. And so try and do that. Same with on the fellow investors. You know, so if you have already investors who are interested, try to get them also to refer other investors. These are usually very powerful ways to get people to get interested in your business. And then stalking on LinkedIn. This is kind of a joke, but you know, not really. I mean, you know, a great way to use LinkedIn is to identify people, you know, investors that you think could be interested in your business, and, you know, start commenting or liking their posts. Follow them, and then start liking their posts, putting a little comment, and then, you know, you can make they will kind of maybe see you there, and then that's a great way then to connect with them on LinkedIn and say, oh, you know, yeah, I like what you shared. You know, I also you know, kind of use that as a conversation starter, and that's usually much more efficient than just, you know, kind of randomly sending them a message and hoping for an answer. Yeah, and then yeah, running it like a sales process. Of course, you know, this is kind of seems quite obvious when you're selling your product, but we really see also the investment process as a sale. Be pushy, not too much, you know, be present, but be on top of things and keep control of the situation. You know, these are really important aspects. So any questions? I can stop for a few questions if there are any.
Yeah, I think a couple just came in here from Daryl. See, regarding geography, what's your experience with angels and VCs based in the US investing in Canadian startups? Guess this
yeah. I mean, just sorry, I was reading the question.
Yeah, I know. Yeah, there's a bit more detail.
Yeah, I mean, usually, honestly, I think, you know, of course, US investors, a bit of a different landscape. What we see is also a lot of Canadian companies actually going to the US and raising funds there. Yeah, I mean, you know, the returns, of course, will be very important. You know, the ability to make, you know, in the US, I think you see a much more quick market, you know, possibilities for higher valuations, but then also high expectations in terms of returns. So that's kind of the, you know, and then creating a lot of pressure on you to actually, you know, fulfill this growth. In Canada, you see a bit more of a conservative market, where people will take more time to decide, what might also be okay with lower valuations, but will take a more conservative approach, and so more difficult to for more innovative business to raise. I think these are the main differences that we see in the market.
All right, and Steve was asking, if the goals of the round are not met, do you have to give the money back that you raised?
So usually, like the funds will be transferred once the round is closed. So if you're planning to raise 50 or 500K and you only raise 300, then you have to have a conversation with your investors and say, okay, should we close the round now, so that I can really focus on the growth with the funding that is committed, and then, you know, kind of work in full transparency with the investors. And if they're, you know, they're keen and they think, you know, you've shown them your kind of worst case and what you can do with 300K, if they think it makes sense, just go for it. But there's no situation where you actually have gotten the money and then have to give it back. You know, usually you would get the money once everybody's agreed that this is the side of the round.
Okay, that's good to know. And then I think I recall Keith usually throws out a number, like if you were trying to raise 500,000, you need to actually raise more to guarantee that.
Yeah, I mean, yeah, I mean, then that's also, of course, like make sure that you are. Maybe I'll just, yeah, or stop share.
Okay, sorry, jumping ahead.
No, just make sure. I mean, it's you have to, of course, if you think you want to have a larger goal, so that you make sure that you have at least the minimum that you need. Of course, that's also it's a good strategy. Then you have also to be ready to explain, this larger round, because this is the number that you're coming up with. And so managing also that, and what happens if you don't raise that much. I don't know. I think it's good to be clear and transparent, to tell what is the minimum that you need to raise to actually operate your business to go to the next phase. You can talk about, a stretch goal, saying, if, of course, if I raise that much more, this is how much more I would be able to do, and, to build the company that much further. But yeah, I think being clear and transparent about how you're going about, about your different goals, that would be important.
Okay, great. Okay, last call for questions. Anything else you want to cover off, Davina?
Yeah, I mean, I think the important here is that, you're in the driving seat. It's your raise, it's your company. Of course, investors, you will hear a lot of things from investors, but make sure that, you kind of also have clear objectives in your mind, that you're comfortable with the decision that that taken. I think, if you have this discussion with the legal team next week, it's also about, legal is also about making you comfortable. And so, make sure that it's still, you stay in control of the process. It might take more time than what you initially thought, but as long as you're comfortable and still motivated by your company and by your raise, these are the most important.
Okay, awesome. I think since we covered so many questions along the way, we are good. So yeah, lots of thank yous in the chat, Davina. Thank you so much for going through the deck.
Yeah.
And for answering all those questions, and to Spring. Spring's been a supporter of New Ventures for a long time, and we're really grateful for the partnership as well. So otherwise, we'll give everyone 3 minutes of their day back. Have a great day, everyone. For those interested in Shred, we will see you tomorrow for a shorter version of the seminar. Otherwise, have a great day. Thanks again, Davina. And Nikki, if you're still here. Okay, bye everyone. Take care.
Bye.